Hi class. I thought that I would do a little sample video for you to just walk you through one of the problems in chapter 16. So let's look at a problem. This is actually very similar to the last problem that you have in your homework for chapter 16. So my numbers will probably be a little bit different, but the basic format and the basic calculations will be the same. So my internet seems to be a little bit slow, but I will get there. Perhaps one day. All right, so you should have logged into Connect. My screen might look slightly different than yours because I've got the instructor view, and this is actually not in your homework. It's just something I set up to walk you through a problem. But basically, you should have something that looks like what I've got. So this says on May 16th, 2019, Safeway Company received a 90-day, 8%, $10,500 interest-bearing note from Black Company in settlement of a past due account. So then we've got a second date that says on June 30th, Safeway discounted this note at Fargo Bank and Trust. The bank charged a discount rate of 13%. And then we've got a third date where something happened. It says on August 15th, Safeway received a notice that Black had paid the note and the interest due on the note. So we've got three different dates. We're working with a 90-day note. The yield on the note is 8%, and the note is for $10,500. So there are going to be some different amounts that we're going to deal with. But what that says in the first sentence, if you can think about a loan agreement, this kind of works like that. So if you were to get a loan for a car, some things that would actually be written on that loan agreement would be when the loan is due, how much interest you're going to pay, and how much the loan's for. So that's basically what that's telling you. The loan or the note is $10,500, and that's what's written on the actual document that they issued. There's an 8% interest attached to that note, and that's actually written on the document, and the note is due in 90 days. Again, those things are written on the document. Now, sometimes companies trade notes or exchange them to the bank or some other party, and they may not get the amount that's written on the note. They may get more, they may get less. They might not get the interest rate that's written on that note. They could get more, they could get less. So we're kind of looking at that in this chapter of what happens when you exchange a note at a discount or a premium. In other words, are you getting more than the face value? In this case would be $10,500, or are you getting less? So we need to know all of those things. So in this one, we're going to start out with the 90-day 8%, $10,500. That's actually what's written on the note. And then anything else that Safeway decides to do in negotiating with that note, we have to take it into account with that. So let's see, we're preparing the journal entries to record those transactions. And then we've got an analyze part. So we've got three journal entries. It says record entry for a 90-day 8% note due for the past due account. So when we record the issuance of a note, we're going to record the issuance of a note. It doesn't tell us otherwise that we're recording it at a discount or a premium. We've just issued a note for $10,500 to someone. So everything that's written on the face of that note, we're going to go by. So the issuance of the note, we're exchanging this person's accounts receivable for a note receivable. So we're, instead of having an accounts receivable where we bill this person every month or every 30 days or whatever, we're issuing a notes receivable in exchange for that accounts receivable, and we're planning on getting that at the end of the 90 days along with the interest. So it's probably somebody that's behind on their payments, and we've restructured that. So if they owed us $10,500 and now we're exchanging that accounts receivable for a notes receivable, this is what's going to happen. We are going to take the $10,500 out of their accounts receivable. That's an asset account, so to get it out of there, we're going to credit the asset account. We're debiting $10,500 to notes receivable, so that's putting it in another asset account. So we're exchanging one asset for another. All right, so the next thing that happened was on June the 30th, we are discounting that note with the bank. In other words, we are giving that note to the bank, and they're giving us some cash for it, but they're not giving us all the cash that we are entitled to. We are discounting it to them. So we're going to do, I'd like to start with what I know first. So we are going to credit discounted, or notes receivable discounted. And if you remember in the first entry, you know what? Yeah, I did it right. Okay, so notes receivable, we had a notes receivable there. We now have a whoops, how did I get that up there? Goodness. Down here, we need a discounted notes receivable. I don't know what I clicked on. Notes receivable, not notes payable. There it is. All right, let me get rid of this top one. All right, so the note that we are actually discounting to the bank, or giving to the bank in exchange for cash, is worth $10,500. So we're going to use the face value to record the amount of the discounted notes receivable. And let's see, we are going to need to calculate the interest that we received for that note. So let me go back up here to the instructions. It said the note was issued on May the 16th. So we have about half of May, and then all of June, and then this event happened. So we have 30 days in June that we should receive interest for, because we actually held that note from May the 16th to June 30th. So we had all of June, which is 30 days, and 15 days in May that we held that note. So 30 days in June plus 15 days in May is 45 days. So I'm going to actually jump over to Excel for just a minute so you can see my calculations. All right, so if you remember the calculation for interest, oops, I mean to do that. Oops. Interest equals the principal times the rate times the period of time. So that's the formula we're going to use. So the interest on our note would equal the principal, which is $10,500, oops, there's 2 zeros there, times the rate, I think that was 8%, so times 0.08. And the period of time is 90 days, and we're thinking about the total interest for the entire 90-day time. So the total interest would be 90 days divided by 360. And the 360 is 360-day year. This textbook, instead of using 365 days a year, they round all their calculations using 360 days a year. So when you do your interest, just with this textbook, use 360 days. So that's our calculation. So let me see what that is. Our interest, if we take the $10,500 times 8% times the 90 over 360, our interest looks like is $210. So the total value of our note equals $10,500 plus the interest, which is $210, equals $10,710. That's the full value of our note. So if we had kept the note ourselves and waited for whoever that was to pay us back, we would have gotten $10,500 in payment for the note and then another $210 for interest. So we would have gotten $10,710. The proceeds that we're going to get from this, we're going to calculate, let's see. We have to take into consideration the discount that the bank is taking. So the bank is actually taking some of that money. So if we are entitled to the $10,710, we're not going to get all of that because the bank's going to keep some of that because they want to make money off of this transaction. So we would get $10,710 less whatever the bank's charging us. And the bank is charging us, and I'm going to jump up here again to the principal times the rate times the time, because that's how we're going to calculate what the bank is keeping. They're keeping some amount of interest. That's the discount amount. So we're going to take the principal, which is, all of this is the original amount, so $10,500. Well, that part's the original amount. I don't know what that's about. All right. It says they are discounting it at 13%. So that's the the rate that we're going to use when we calculate the proceeds. So instead of the 8%, they're charging us 13%. Whoops, and I don't need the percent because I've got the decimal. And the period of time is actually what's left on the note. So it was a 90-day note. We used up 45 days. They're going to have it for the next 45 days. So the period of time is the remaining 45 days divided by 360 days out of the year. So if we do the math on that, let's see, let me put it up here. We would actually get $10,535.96. All right, so if you can see how I did that, I calculated the interest here, and then I subtracted that out of, or I calculated the proceeds here, and then interest, and then calculated out that which was the total value of the note. And this is what the bank's actually given us, $10,535.96. They're going to get what's the difference between those two. All right, so we have one more thing we've got to do. We've got to figure out how much of that is interest. And that's pretty easy. For us, whoops, jumping over here to the wrong screen. The interest we received would be the $10,535.96. That's the total amount we're getting. But of that amount, $10,500 was the principal amount for us. So the difference in those two, which is just $35.96, that's the interest. So if you can kind of look at these, we calculated the total value of our note if we had kept it. Then here we calculated what the bank was keeping, and we subtracted that from the total value of the note that we would have had. So the difference in what the bank is giving us, which is the $10,535, and what we would have received initially, that's the amount of interest that we have left. So I'm going to jump back over here to connect, and we actually had some interest that we just calculated, so we've got to record that interest, and that would be interest revenue or interest income, and that's the $35.96. And the other thing that you have to think about, well, if we gave this note to the bank, what did they give us? They gave us cash. So the cash that we gave them, or they gave us, and then we just calculated that, was $10,535, whoops, and 96 cents. All right. And then it says record payment of discounted notes receivable. Excuse me. So we are going to get rid of the notes receivable that we have on our books, and we're going to get rid of that discounted notes receivable. So remember over here in the first entry we recorded a notes receivable. And in this entry, we have a discounted notes receivable. So we had one was a debit, one was a credit. We're getting rid of both of those. So the amount that we're going to record for those is the amount that's actually written on those notes, and it's also the amount that we recorded here in step 1 and down here in step 2. So we're just wiping those off the book. So $10,500 comes off. And this is what we should have, something like that. Let's jump back over here. And it says, if the company prepared a balance sheet on July 31st, how should notes receivable discounted be presented on the financial statements? All right, so I'm going to come back over here and look at our journal entries. We're doing a balance sheet, so, and it's asking specifically for notes receivable and notes and discounted notes receivable. So on our balance sheet, we're doing the balance sheet on July 31st. So that's the important thing. This last entry happened on August the 15th. So that's after the date of our balance sheet. So you can just disregard that for the analyzed portion. So on the analyzed portion, for the notes receivable part of our balance sheet, we have a notes receivable of $10,500, and we have a notes receivable discounted for $10,500. So we're going to put our notes receivable in here, and our notes receivable discounted. Those are actually the two things that are going to show up in this section of the balance sheet. Both of those had a balance of $10,500. So you'll see they offset, and you actually have a 0, and I don't think anything goes in that last box. So let's check and make sure we've got it right. So it's going to look like this. You'll notice once we discount that note to the bank, they gave us money, so we have cash. We're not actually holding that notes receivable at the moment. The bank has it, and we have recorded the notes receivable discounted on our books to show that those two are offsetting each other. So they're basically a wash. We have an asset, and then we have the notes receivable discounted that's offsetting that. So our net balance of that is a $0. So the bank's actually holding that notes receivable. So when all said and done, that's what it's going to look like. When we get to August the 15th and we wipe both of those off of our books, then neither of those would be on there. They would both be 0 because we took them off our books. So I hope this helps with the homework for Chapter 16. As always, if you have any questions, feel free to send me an email or contact me some other way, and I'll be happy to help you.